I absolutely love that. So the process for me to make this investment, obviously I was doing the marketing for it when we were doing the capital raise. And I was like, you know what? I believe in this company so much that I'm going to make my first investment. I had no idea what it really meant, no idea what I was doing, but the process was really simple. So I jumped online, I bought these shares, but can you tell me what that means? Like, I'm a shareholder now, right? Can you actually explain to me what that means? Because I still don't really know.
Okay, so when you buy shares in a company, you can either buy shares for dividend purposes or you can buy shares for growth. So investing in any startup company, which is pretty much any new PTY Ltd company that's starting, you're essentially investing for growth. So in Got Cakey's situation, you have made an investment into a startup company. We're a tech company. You've made an investment at the most earliest point in the company's journey, really. So that's the best time to get on, and that's where you're going to get your best reward if we were to, have significant growth.
When we go huge.
Yeah. So look, when you have shares in a company, you're essentially a part owner of that company.
So I'm your boss.
Yeah, essentially, Blaze and I work for you. Yeah, that's right. Yeah, so, we work for you always. So you're essentially a part owner in the company. So you own a small chunk of that company, and at a point in the future, the reason anybody invests is because they're hoping that when they actually go to sell those shares are worth more money. Mm-hmm. So it's a buy now, hold, and hopefully in the future you can sell those shares and appreciate those shares have appreciated. I've probably answered that all wrong.
No, that's perfect. And so talking about selling shares, what would happen if I wanted to sell my shares? What is the process of that and how do I go about that?
So when you invest in a private company, it's really difficult to sell your shares. So when a startup starts, it's very, 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 very rare that a startup company will actually establish themselves as a limited company. So 99.9% of companies will start as a PTY Ltd. And when you buy shares in a PTY Ltd company, it's very, very difficult, almost impossible to sell those shares. But look, before you get too stressed out thinking I've bought shares in something that I can't sell, there will come a point in time, should the company go well, that you will be able to offload those shares. And offloading shares, the professional word for that is to have a liquidity event. And so currently the shares that you own are illiquid, but you want to convert them to liquid, which means have a trigger moment for you to be able to sell or have them acquired. So when you've purchased very early into the company's journey, and the question all shareholders should be asking is, okay, if I can't sell my shares now, when reasonably will this company have a liquidity event? So when you invest in a company, we did our raise on Birchall. You really need to be, I suppose, make yourself as an investor. You need to understand how good is the founding team? Do they have a strategy for exit to have a liquidity event? Because ultimately you don't want to go and invest in a company that 10 years later you still have shares in and they haven't had a liquidity event. They haven't exited, off that journey. The exit opportunities for private companies is either get acquired by a bigger company where essentially they come in and buy out all the shares in the company. And Terry, you get a letter from our chairman saying, look, you're getting dragged along in a decision we've made as a board. We've had an offer come through for $50 million for this company.
And we're going to be rich.
Yeah. And we're going to accept that offer. And that essentially means when somebody comes in and buys out the company for, let's say, $50 million, because like at this stage of the company, I think 50 million, that would have to be like the absolute limited, like minimal amount for us to even consider selling the company at this stage because there's just so much upside with it. But if someone came to us and said, we want to offer you $50 million to buy out your company right now, how you get paid would be, so when they buy it out for 50 million, they're essentially buying every share in the company. So if we have 100 billion shares on issue, it's essentially going 50 million divided by 100 million to be able to get that share price. I actually can't work out that calculation. That's like I'm live on camera. So let's say that you've bought your shares for 1 cent and the 50 million divided by 100 million, that's where you're going to get the appreciation of value. Can someone actually work that out for me, Blaze? What's 50 million divided by 100 million? So I'm going to have to go back because that sounds really dumb, right? Blaze. Why?
What is it? Hey Siri,
I can't.
what's
They're not.
50 million divided by 100 million? Was that the figure?
Okay.
It's 0.5.
Was it 50 million divided by 100? What?
Yeah, it's at 50 cents.
Yeah,
Blaze?
0.5.
That would be 500,000.
Sorry.
So can you do it? 50 with 6 zeros divided by 100 plus 6 zeros. So 0.5? So it's 50 cents. Okay. All right. So I'll start that like a part of it again, right?
Yeah, just go
Okay.
from wherever you. Yeah.
Okay, Terry. So let's say that we get acquired. And what that means is a letter of offer comes to our board, whether that be solicited or unsolicited. We get a letter and one of our big acquirer targets comes to us and said, we want to buy your company for $50 million. How we work that out from a shareholder point of view as to how much you're going to get, the calculation is the value of the offer. Let's say it's $50 million because that's the absolute minimum that Blaze and I would accept if an offer was to cross our desk now. That might sound like a lot of money, but it's absolutely nothing compared to the upside that exists with this company. So $50 million offer crosses our table. We simply divide 50 million by the number of shares on issue. We have a little bit over 100 million at the moment, but let's just call it 100 million shares. So you go $50 million divided by 100 million shares, and that, if my corrections are right, is 50 cents, right?
Nailed the math.
Nailed the math, thank you. So what would happen if we accepted an offer of $50 million based under our constitution? You would get dragged along. You have no rights to stymie that. You would get dragged along with our decision whether you liked it or not. We accept the offer. One day you'll get a letter written to you saying, well, Miss Kearns, congratulations, there's been acquirer. Your investment is now exiting, and they're exiting for 50 cents a share. What did you buy your shares for? I'm pretty sure that you bought them for 7 cents.
I couldn't tell you.
Yeah. So I think you bought them for 7 cents. So that is going to mean
I'm rich.
yes, well, essentially. So you've made about 8x your money.
Yeah.
So that is where you have a liquidity event, is if we get an offer and get bought out, because being acquired means that all of your the whole shares that exist in the company just get bought out. So they don't belong to you anymore. They now belong to ABC company who's purchased us. The other way to exit is if we decide to list the company on the stock exchange. And there's many different stock exchanges that exist. And once upon a time, I didn't really understand it, and I'm not a full bottle on it now. So that is where we have a listing process. We may choose to list in Australia. We could choose to list in London. We could choose to list in America. So here in Australia, you've got something called the ASX, which is the Australian Stock Exchange. Whereas in London, it's the London Stock Exchange. Hong Kong, they've got a couple of stock exchanges. So it's really about finding the right exchange for you to list on. But from an investor point of view, the most important thing is, have we listed? So as soon as we list on an exchange, it essentially means you can sell your shares. You can buy tomorrow or buy today and sell tomorrow. So if we don't get acquired or we don't list on an exchange, you're kind of stuck with your shares unless the company agrees to buy them back off you, which is very, very rare. So $1 million question, when are we going to list? Really hard to put a figure on that, because we don't know what the macro environment's going to do. We don't know how the company's going to trend. We don't know how long it's going to take us to hit critical mass. But put it this way, you can't go and list on a stock exchange when your company's traveling bad. So you need to wait until you've got some momentum behind you, whether that be you're profitable. A lot of companies, we look at, Guzman y Gomez recently listing, profitability is not the number one thing to, need to have to be able to list. But I think the determining factor is you need $2.5 million worth of assets within your company, or at least I think it's about $2 million worth of revenue. A company like Got Cakey now, where we're in our beta stage, we are very, very, very far away from hitting critical mass. We can't satisfy either of those two criteria. So listing for us on a stock exchange is just simply out of the question at this point in time. So the only options we have available to us right now is to be acquired. And it's highly unlikely that is going to happen because there's just way too much upside with this company to sell. So having an investment in a startup is generally, you really need to be looking at 4 to 5 years reasonably at such an early stage of the company before you're looking at having a liquidity event. So just in summary, for anyone that has invested in Got Cakey and anyone that is looking to make investments in other startups, the hard thing to know as an investor is this company likely going to have an exit? Because if you invest $1,000 into a company, unless they've got the right team, they're going after a big enough market, and they've got the right funding, there's a very good chance that company may never exit, and therefore you can't convert that to cash. But rest assured, I think you got a pretty good team here at Got Cakey. That's one of the biggest priorities that
Shout out to the marketing team.
Oh, marketing for sure, but it's also our tech team, it's also our strategy team and our capital raising team.
Everyone's